What if the entire value of your portfolio was available to you in cash? Not hard cash, of course, but in your bank account, ready to invest. How would you go about investing it today? Would you buy the same stocks that you have in your portfolio, or would some of those pesky little penny stocks and value traps go straight to the trash? Most importantly, what is stopping you from making these changes? It's your money, right? But I'm not here to give financial advice, so I will focus on what I do best, which is analysis. Today, we will discuss stocks that I will be buying over time as the market finds its footing. This includes high-risk small and mid-caps, consistently compounding large caps, cyclical stocks that we must buy in and out of at the turn of every cycle, and the backbone of any portfolio, dividend stocks that can outperform the market. Let's begin. Small and mid caps make up 25% of my portfolio because I like to take risks, and of this 25%, half goes to potential multibaggers, meaning stocks that have the potential to give us 20x returns in 10 years. Naturally, we're looking for stocks with very small market caps but a long runway for growth that they have a moat around. Inox India is one of the stocks that fits this bracket perfectly. This company has a patent in collaboration with ISRO for a cryogenic module that can be used to transport liquid hydrogen. Now look, for green hydrogen, transport is the riskiest part of energy generation, and Inox India has an absolute monopoly on it. FIs are increasing their holding with Goldman Sachs as the flagship investor, and promoters have not sold a single share in this downfall. They still own 75% of the stock. This is another one of those. It's a deal that feels like a steal. Max India is next, and they have housing societies that exclusively cater to retired and elderly people, and they're already sold out. They have care facilities for the elderly who need more personalized medical care, along with at-home support for senior citizens. India's senior population is also growing at a faster rate of 4% annually than the general population, which is at 2% annually. The Indian senior care market is projected to grow to 42.2 billion by 2032. Add to that, the radical change in the modern Indian family necessitates specialized care centers and societies for the elderly. As parents from our generation seek independence by moving away from their children in old age, the demand for Max India's products should rise exponentially. The best part is that it is a trend that is still considered a bit taboo, allowing a savvy investor to capitalize on a dogma. Rainbow Children's Hospital is a market leader in pediatric care, an industry with plenty of room to grow. Rainbow is expanding fast to meet this growing demand by investing 900 crores to increase bed size by 40%. They launched a new hospital in Bengaluru this year and are planning to add 3 more over the next year. Using their current hospital performance as a benchmark, we can assume base sales of around 100 crore per new hospital, which at 33% operating margin creates about 120 crores in additional profit in FY25. That's 40% higher profits this year. No wonder the stock hasn't really corrected in this fall. The retail holding is shrinking, and the stock has maintained its upward trajectory even in a volatile market. Knowledge Marine Engineering Works is next, and they work in the maintenance of marine crafts and dredging. A very boring business, but you know I love boring businesses because boring makes money. They work with port authorities across the country, and with India's renewed focus on its coastline, it's only a matter of time before orders start flowing their way. The best part? They have very little competition. That could explain the sharp increase in FI holding over the last quarter. The stock is a little expensive, so I would buy nice and slow. It takes patience to build a portfolio. It's going to have a bad period, and that's when I'll shut my ears to the noise and buy. Next, we have future consistent compounders, and the first stock that I like is Ether Industries. India imported around 16 billion in chemicals from China last year, and a large chunk of those imports came from APIs and industrial chemicals. Within this space, Ether is one of the leading names and is one of my favorites in the chemical sector as a whole. They also export to some of the largest markets in the world and have a monopoly on most of their products. They have recently expanded and are delivering on their promises. Their management is very well educated and committed to the company. This is a stock that I would buy and just forget. In time, it will deliver massive gains. Esconet Tech is next, and businesses worldwide have accelerated their digital transformation, which increases demand for cloud services, cybersecurity, cyber infrastructure, and AI-driven solutions. Esconet Technologies is placed in the sweet spot here, where high-end computing meets data storage and cybersecurity. It has massively corrected and is available close to all-time lows. I know that might seem bad, but hey, this is when we should be buying into strong companies if we want to outperform the index. Next up is Acume's Drugs, and they're the largest CDMO player in the Indian market. So it's not like I'm going into a penny stock. They control 1/3 of the entire CDMO market in India and are now exporting a novel drug for sickle cell anemia to Africa and Nepal. They're also increasingly becoming the go-to supplier for the entire country, with PM Modi committing to making India free from sickle cell anemia over the next few years. Acume's Drugs, this single product, can be a game changer. Next up, we have turnaround stories, and they can make a valuable part of any portfolio because A, we get to enter stocks with a long history, so they're relatively safe, and B, these stocks are usually very beaten down, so the risk to reward ratio is almost always stellar. These make up only 5% of my portfolio because these companies are also notoriously volatile and unpredictable, so selectivity is of paramount importance. Investments must test for the following boxes: a tangible change from the past behavior, a trigger that can ignite performance, and finally, a good entry price near technical supports. I have 3 companies that check all the boxes for me. ABFRL's big change is the move from physical stores to online presence. The stock's biggest bane has always been the high cost of its showrooms. The company paid 1,300 crore in depreciation cost last year. Remove that and the stock would have been trading at an EPS of 5 rupees. That would give ABFRL a PE of 15. An enormous undervaluation. As ABFRL clears out this deadwood, a re-rating is on the cards. Next up is Sammaan Capital, and their transformation comes from a change in promoters. The company has moved into the hands of PE firms and large investment firms such as BlackRock. These giants know how to turn a company around, and at least enough to make a 3 or 5x return for themselves. Smart investors usually hitch a ride on these firms. Think of it like tailing an ambulance in public. It might not be the classiest thing to do, but it is practical if you're a hustler. Finally, we have J&K Bank. This bank's change of fortune stems from the general stability that India's crown jewel of Kashmir, Jammu and Ladakh are in. Yes, there will be upheavals, but the partition of the territory allows for better governance. Our borders are also more secure now than ever in history. I, in fact, am actively looking for opportunities to invest in this region, and J&K Bank is one of the simpler ways to create a small exposure to our pride's growth. Let us now move on to cyclical stocks, which would be another 25% of my portfolio. These are companies that must be bought into during the end of their down cycles because their rebound is very sharp and high beta. Tata Motors, for example, has not given great returns over its entire history like an HDFC Bank. But if we buy into this stock at its worst, then it gives us a 10 to 15x return in just 3 to 5 years. If I had bought into Tata Power in 2009, I would have gotten a 15x return in 5 years. For comparison, an HDFC Bank over the same period would only have given me a 5x return. That's a lot, but nothing compared to the 15x that Tata Motors gives me. Remember, this is a blue chip company, so I'm not taking as big a risk on Tata Motors as I would on an Escalent Technologies or Data Patterns. A good entry point for Tata Motors would be around 240, but in tranches, because historically speaking, it can go all the way down to $100 as well. Delta Corp is another company with similar fortunes. Pick it up at the right time and you get a 4x return in 2 years. Right now might be one of those times. Around 60 to 65 might be the perfect price to pick up Delta Corp, with possible downside to 40, which is a 15-year low. The upside though caps out near 300, so we're looking at a 5x return. The reverse is true for stocks like Indian Hotels and Lodha. If you're someone who likes to short, it's possible to short Indian Hotels right now because there's a 80% drop possibility. It can go as low as 150. It's unlikely, but still makes a great case for a short. Even OMCs seem primed for a short, and I do have a short position on them that I've recently gotten into. Next up, we have consistent compounders and dividend stocks that make up between 50 to 40% of my portfolio. And by the way, if you're learning anything, please drop a like even if you don't subscribe. Here, we have 3 consistent compounders and 3 high dividend stocks. The consistent compounders are Pidilite, Supreme Industries and PI Industries. The reason I picked them over an HDFC, ICICI or Bajaj Finance is because they are less spoken of. That means these will continue their journey until they reach a saturation. These are also boring businesses, and you know what I always say, boring makes money. For high dividend, we have VST Industries, Axelia Solutions and Irida. Now I know Irida does not pay a dividend at the moment, but I'm willing to bet that it starts paying out strong dividends once it stabilizes. VST Industries is primarily included because it's corrected by a lot. As OMC is correct, I would be adding them and replacing one of these stocks. Axelia Solutions is the riskiest company in the slot, but since they have an excellent track record of dividends on top of their in-demand industry, I just couldn't stop myself from including them.